Hi, everyone. Thanks for joining. I'm Judah Levine, Head of Research. Welcome to the Freightos Global Freight Market Outlook for February. In the next half hour or so, I'm going to run us through our ocean freight and air cargo update. We're going to be looking at demand trends and the different factors impacting the market now, especially the fast-moving developments in the Trump trade war that are impacting the market. And along those lines, because there's going to be a lot of issues regarding tariffs and customs, things like that, I'm very happy to welcome back Adam Lewis, who is the founder and president of the North American customs broker Clearit. And so after our update, he's going to share his insights on these developments and the impact of tariff hikes, changes to de minimis, all this type of good stuff, and let us know what he thinks. So Adam, if you want to introduce yourself and maybe tell us a little bit about Clearit.
Thank you, Judah. Again, my name is Adam Lewis. I'm the co-founder of Clearit Customs Brokers. We offer both U.S. and Canadian customs services in a quick, compliant, and affordable and fully digital manner.
Awesome. Okay, so Adam, we'll be hearing a little bit more from you, or hopefully a lot more from you, but a little bit later on. Okay, so also at the end, we'll save about 10 minutes or so for some Q&A. So please feel free, if you have questions at any point during the presentations, to use the Q&A function in Zoom to submit your questions, and we'll try and get to as many as time permits. Okay, so if we start with the trade war, and I thought it would be helpful to provide kind of a timeline of the developments so far to put things in order. So really, before even taking office, and this includes during the campaign and certainly since the election, President Trump had been talking about plans for tariffs. At the time, before he took off, proposals were for 10 to 20% global tariff. Then there was talk of 60% tariffs on all goods coming in from China. And then closer to Inauguration Day, that he was promoting 25% tariffs on Mexico and Canada, which he said would go into effect on Inauguration Day. So on Inauguration Day, those did not go into effect, but on that day, President Trump released his sweeping America First trade policy memorandum, which, among other things, in addition to calling for a review of the USMCA, which is the trade agreement with Canada and Mexico, and calling for an assessment of fentanyl imports, this memo directed the relevant federal agencies to investigate and make recommendations regarding the state of really U.S. trade, of U.S. manufacturing, of overall trade deficits, to review different exemptions to steel and aluminum, for example, to those existing tariffs. Also a focus on, as we said, Canada and Mexico, but also a focus on China, the degree to which China is complying with existing trade agreements, and also assessing the losses to tariffs as well as the risks associated with the ongoing surge in de minimis imports. So these requests for investigations, which were kicked off via this memo, really followed the same model that Trump used during his first administration in terms of the tariffs that went into effect then. This is the first step in an often months-long process that culminates in the actual implementation of new tariffs or trade policies. And those come after these federal agencies like the U.S. Trade Representative submit their recommendations. And so this memo set an April deadline for those requested reports and recommendations. Trump also said that he would likely move forward with those Mexico and Canada tariffs on February 1st. And indeed, on February 1st, Trump became the first president to use the International Emergency Economic Powers Act, the IEEPA, to increase tariffs. And Trump pointed to the illegal flow of fentanyl and immigrants from Mexico and Canada and China, or these fentanyl or immigrants, calling this the national emergency, and saying in response he was implementing 25% tariffs on all Canadian and Mexican imports into the U.S., cancellation of the de minimis exemption for goods from those countries until the situation had improved. He also signed on that day a 10% tariff increase and the suspension of de minimis for all Chinese goods, also in response to the illegal flow of fentanyl. 2 days later, though, the president determined that the Canadian and Mexican government had each committed to improving border controls, and those commitments were enough to be considered an improvement in the situation, and therefore he suspended those tariffs and restrictions for a month, so until March 4th, at which point the effectiveness of these steps were going to be reassessed, and then determine whether those tariffs will be remain suspended or reapplied. The tariffs and restrictions on China, however, remained in place. But then on February 5th, the president issued a new order which temporarily reinstated de minimis for Chinese imports. So this allowed, in order to allow U.S. Customs and Border Protection time to develop methodologies and adequate systems to process what was expected to be a sudden surge in formal entry imports from small parcels that were entering via de minimis. This new order keeps that 10% tariff in place, and China responded with a retaliatory tariff of 15% on a list of U.S. goods, as well as some other steps. So all this drama had really heightened the concern over how completely or possibly unpredictable and possibly disruptive the second Trump administration could be or may prove for trade and logistics. And Trump's pick for Commerce Secretary, Howard Lutnick, made a distinction, and there's been some talk about this distinction since then, between the different types of tariffs. So the China tariff, as well as those that were temporarily on Mexico and Canada, are really action-oriented or what's being called punitive tariffs. They're being used as leverage really for non-trade issues, like we said, fentanyl smuggling and or illegal immigration. And for those, Trump leveraged that IEEPA, that trade act, which in response to national emergencies, and therefore these types of tariffs can be removed when steps are taken to address whatever the issue is, like we saw for Canada and Mexico. And those punitive tariffs are as opposed to structural tariffs, which are aimed at trade issues themselves. So some of which will likely only come after that longer process we talked about being kicked off by the trade memo on day one in April, when these federal agencies like the U.S. Trade Representative will submit their recommendations. And for these, again, the intent is more trade oriented, so these may not be as quickly revoked because they're not pointed at something as specific or as this particular flow of illegal goods or something. So these might not be removed, or expectations that these could be removed as quickly. Although we saw during Trump's first administration that these sometimes are also used as leverage for negotiations. And for example, in 2019, when there were trade negotiations between China and the U.S., some of the announced tariffs were altered. But some of these structural ones are already being acted upon. So this week, President Trump announced 25% tariffs on all steel and aluminum imports, which will go into effect on March 12th. And he stated his intentions to introduce new tariffs on other types of goods and commodities like computer chips, pharmaceuticals, copper, and oil and gas imports, and these as soon as mid-February. And he also promised tariffs on Europe as well, although he didn't give a specific timeline. And also this week, he announced intention to roll out reciprocal tariffs, and to do that soon, which essentially would roll out equalizing tariffs on any countries that currently have tariffs on U.S. exports. So these could include countries like India, Brazil, Vietnam, Argentina, other countries in Southeast Asia and in Africa that have tariffs on U.S. exports, like certain agricultural goods or vehicles. And there was just a Wall Street Journal article that said these types of tariffs could also reciprocate for non-tariff but other types of barriers on American companies in other countries, like value-added taxes or subsidies that domestic companies receive, but U.S. companies trying to operate there do not. And this could apply to countries like Japan or some countries in the EU. These reciprocal tariffs, though, there's some speculation that these might be in place of that proposed 10 to 20% global tariff, and therefore not apply to all U.S. imports. And these would kind of fall somewhere between punitive and structural, because they're more specifically directed at something that country is doing. And if their tariffs are removed, then our tariffs are removed. If their trade barriers are removed, our tariffs would be removed. Not our U.S. Tariffs would be removed. So that's kind of the state of affairs just in the last couple of weeks since February 1st, when these have been introduced. And so looking into the future, we really have two deadlines, and you can see that my timeline here got a little asymmetrical because it changed a lot since the time I first put it together. That's how fast moving things are. So looking into the future, we have these two deadlines, one on March 4th, which is the reassessment of the Mexico and in Canada 25% tariffs and de minimis suspensions there, which again are in response to steps by those governments to address the flow of fentanyl and illegal immigration. And we also have that April deadline, which is the due date for these recommendations from the federal agencies exploring these much broader issues of trade deficits with possibilities of that 60% tariff on China also being possible through that channel. And just to note, this 60% would be on 100% of Chinese imports into the U.S. If we compare that to the first Trump administration, the tariffs we had then only targeted about 2/3 of all Chinese goods, and the highest level was tariff level was up to 25%. So 60% on 100% of those goods, 60% tariff on 100% of those goods would be much more significant than what we saw in the first Trump administration. So what has this meant for freight? So as we said, recent events are probably going to heighten concern over coming sharp tariff increases on China later this year. This development means we could expect front loading ahead of these tariffs. This has been a major factor keeping U.S. ocean import volumes and trans-Pacific container rates specifically quite elevated since November, or more elevated than they otherwise would have. And we could expect possibly that this front loading will continue or even intensify as we see that President Trump is following through on these things that he had been talking about since the campaign. And we can see that these factors are in fact reflected in volume data and in projections. So here we're looking at U.S. ocean import volumes and projections from the National Retail Federation. We see for 2024, this early peak season that we've talked about before, shippers front loading. This is mostly ahead of that October 1st strike. But then if we look at the dotted line back in November, these are the NRF's projections, and the projections were that through Q4, volumes would decrease. We're past peak season, we're past the strike. Volumes would decrease like they normally do after peak season. But we see that since then, actually, volumes have remained quite elevated, much more elevated than was expected. And we see, and this is really since November. Some of this was front loading ahead of a possible strike, a renewed strike in January. But we saw certainly another factor is the election results in November, that we saw a volume stay elevated. We see that projections or estimations are that volumes were quite elevated in January, less so in February due to Lunar New Year. But then afterwards, we see rates go up, expected to be quite strong again. And this is normally what is a slow season for ocean freight. After Lunar New Year, before peak season, we normally have a lull in demand. And here we see demand is going to be quite elevated above that 2 million TEU per month level. And again, these projections are really reflecting that possibility of continued front loading, even what's meant to be slow season. We can also expect that if we're seeing front loading now, that front loading is pulling forward demand that would normally come later in the year. So if we, in fact, do see this kind of strong demand earlier in the year, and tariffs actually do go into effect, we're likely to see lower demand and lower volumes, and as we'll talk about, lower rates later on in the year, which would mean more of a subdued peak season. And that could happen even if there aren't tariffs, just because enough inventories have been pulled forward. And certainly if there are tariffs, then shippers are going to be more reluctant to bring in goods while those tariffs are still in place, especially if they've built up inventories. They will kind of hold off as long as they can. Okay, so what does this look like in terms of ocean rates? So here we'll turn to our Freightos terminal. We're looking at Freightos Baltic Index rates for 40-foot containers in the spot market. And we're going to start here with Asia, Europe, and Mediterranean. So Asia, Europe is in the brighter purple, FBX 11, and to the Mediterranean is in purple, the FBX 13. And we can see that there really was kind of typical seasonality in 2024, but quite skewed in terms of the timing, so coming a little bit earlier than usual, and also in terms of rates, highs and lows, due to Red Sea diversion. So we see before the Red Sea diversions or Red Sea crisis started at the end of October, rates were even lower than they typically were, because there was something of oversupply at the time. Then with the Red Sea crisis, we had rates spike, up to $6,500 per container to the Mediterranean. But even after that quite significant spike, we did see seasonality. So rates decreased after Lunar New Year, like they usually do, but they went to a floor that was about double typical levels, $4,000 to or $3,000 respectively to Mediterranean and Asia. Then we had an increase during peak season, a decrease afterwards, and now we have an increase again before Lunar New Year, and now easing again as Lunar New Year period is behind us. So we have the seasonality, but we have this elevated floor of about $3,000, $4,000 per container, which is about double typical levels. Again, the timing also was earlier for Lunar New Year as well. Rates started increasing all the way back in November, because shippers in this lane didn't want to be stuck without goods during and then after the Lunar New Year holiday, because of these much longer sailing times that they are facing. So because of that, we're starting to see rates decrease now. Sometimes there is a bump in demand and rates just after Lunar New Year because of a backlog that was created. That doesn't look like it's the case this year. Again, probably because shippers started very early, aren't in a super rush to order more goods because they stocked up, and therefore, they are going to enter that kind of peak post Lunar New Year lull, and we're seeing rates decrease. So we're seeing rates easing to Europe. Rates now are 40% lower than they were in the lead up to Lunar New Year earlier in January, and it's likely that rates on these lanes will continue to slide. Again, for the reasons that we've talked about, but also because the new carrier alliances that were just introduced are being rolled out now in February. That might be driving a little additional or intensified competition as carriers are competing to attract shippers to these new alliances. So indeed, there are reports now that carriers are increasing blank sailings for later on in February because of the expectations of slowing demand. So with rates now at about $3,400 or $4,500 per container on these lanes, they're already about at that floor that we saw, this Red Sea adjusted floor that we saw last year, and carriers want to work to keep rates from sliding much further. If we shift now to the Trans-Pacific, we see something similar, but also with some important differences. So here as well, we're looking at Asia to West Coast rates in green and to the East Coast in blue, and we see kind of the same shape, right? A big increase during the start of the Red Sea crisis and lead up to Lunar New Year, a decrease after Lunar New Year to a floor of about double typical levels, $3,000 and $4,000 per container. We saw an early peak season. Again, this is probably mostly, excuse me, due to the expectations of a strike. And then rates come down afterwards, but we see they stayed higher, right? They stayed about $1,000 or $2,000 per container higher than the earlier floor. And then since had a bit of a lull, probably after it was too late to bring in goods for ahead of the January strike deadline, and rates increased ahead of Lunar New Year up to about $7,006 per container. We've had a little bit of easing since then, but they haven't come down like we saw those for Asia Europe. Daily rates now at about $6,400 per container to the East Coast and $48 to the West Coast. So we could expect some post Lunar New Year backlog, excuse me, and that might support these rate levels or even some increase now that Lunar New Year is over if there was backlog. And then normally the Trans-Pacific container market would enter slow season like we saw last year. Rates would decline after Lunar New Year like we saw for Asia Europe, and we'd be in something of that lull until peak season orders start pushing demand up. But as we saw in our volume projections from the NRF, it's very possible we'll see the Trans-Pacific and possibly on transatlantic as well, that we'll see shippers continue to front load to get ahead of those tariff increases. So if that's the case, it's hard to say how significant an impact this will have on rates because many shippers, as I said, have been stocking up since November. But we could see some upward pressure on rates if there's a real sense of extra urgency now that we've seen all these tariffs go into effect. Maybe it will be even stronger. So that could put some upward pressure on rates, or at very least, we could maybe expect very little relief in rates in what's meant to be a slow season, at least until the tariff situation becomes clearer in terms of levels, in terms of timing, in terms of whether they're actually going into effect or not. So if we use those NRF projections as a gauge, volumes into Q2 will stay at about where they were in November, December. So maybe we could expect rates to remain elevated at about the levels we've seen recently, which again is about more than $6,000 and almost $5,000 per container, which are 2.5 times what they were in 2019. And again, we're starting from an elevated kind of floor because of the Red Sea impact on capacity across the market. And then finally, as we said, we could see, if we're seeing unseasonal demand strength in the first few months or in the first half of 2025, then we could also expect lower demand and lower rates during what's typically peak season. Again, depending on the tariffs and depending how much inventory is built up before then. Okay, if we turn now to air cargo, and then we'll bring Adam back. Okay, so now turning to air cargo and back to the U.S.-China trade war. So as we said last week, President Trump canceled and then reinstated access to the de minimis exemption for Chinese imports to the U.S. And if we talk about de minimis, the savings from de minimis via not paying duties but more importantly, also not paying customs filing costs, which can be between $15 to $50 per shipment, as well as the speed of not taking long to clear customs if you come via de minimis. These aspects of bringing goods in via this exception really affords low value imports the option of coming via air cargo. So it's really been de minimis has been a real facilitator of the flood of parcels that have come into the U.S. and Europe. To the U.S., more than 1.3 billion de minimis packages entered the U.S. in 2024. To Europe, it was more than 4 billion. I'm sorry, to the EU is more than 4 billion. And again, this is really facilitated by de minimis exceptions in these countries and regions. And again, these packages are mostly from China and mostly coming by air cargo, which likewise makes sense because this is a fast way to ship goods directly to customers in these, in the US and in the EU, all the way from China. So e-commerce shipments are accounting for an estimated 50 to 60% of China to US air cargo volumes, an estimated 20% of air cargo volumes overall. And I think that estimate is probably even a little bit low. This accounts for dozens of freighters each day out of China. Total capacity out of China, therefore, has increased 25% in 2024 compared to 2023. Again, in response to this surge in demand. So starting with the US, China accounts for around 2/3 of the de minimis imports into the US, or accounted for 2/3 of those 1.3 billion into the US last year. And the abrupt shift in status of the millions of these daily packages, which were coming for de minimis, and all of a sudden have to go through formal entries when de minimis was suspended from China last week, that was poised to really quickly overwhelm customs and lead to severe customs congestion and backlogs at US airports, which would cause real delays for individuals and businesses to receive those packages. And that's probably a key reason why the president reconsidered and paused the cancellation, at least temporarily. I would think that the pause may also serve as kind of a wind down period for these B2C small imports from China. And during this wind down, Chinese e-commerce platforms may shift away from as heavy a reliance on de minimis and on air cargo. So these platforms have already been increasing their use of ocean freight because this has kind of been anticipated that these changes were coming to these rules. They've been building up inventories by ocean in the U.S. and also in Mexico. There are also reports this week that for American shoppers on Temu, the platform is promoting items from sellers that already have inventory based in the U.S. to avoid these issues. So when U.S. de minimis for Chinese goods is canceled, and again, we don't know the exact timeline. The expectation is that this will happen at some point. We can expect a probably significant drop in volumes and air cargo volumes and rates, and a spike in available capacity, which could push rates down significantly. But with de minimis for China reinstated for now, rates may not collapse immediately. And as when we look at rates, we see they haven't really changed yet. Prices may remain elevated up until U.S. de minimis is once again closed to Chinese imports, or we could see kind of a gradual but likewise significant decrease during this period if we do start seeing a shift away from air cargo before that rule change goes into place. And as we'll discuss with Adam, it's also possible that air cargo will be continued to be used for some e-commerce shipments even without de minimis available. So the degree to which we're going to see a change is kind of a subject of speculation, but I think certainly we're going to see a decrease in volumes, demand, and rates in a significant one as these changes go into effect. The European Union, as we said, has also been flooded by these low-value Chinese imports since 2023. And officials there have increased scrutiny of these platforms, including Temu and Shein in recent months, due to the increase in unsafe products entering the European Union and illegal goods, as well as complaints of unfair competition to domestic sellers or domestic businesses, which are the same issues that we're seeing challenged in the U.S. Just last week, though, the European Commission released a list of proposed actions to take in response to these challenges to the state of affairs. And this included the removal of the de minimis exemption. And there are reports that this change would be introduced only in early 2026. So this isn't kind of an abrupt change like we saw in the US and then rescinded. And the proposal is that these types of packages would face a handling fee. So perhaps they're not going to become a formal entry immediately. There'll still be some kind of special status, but there'll be a handling fee and additional information required for these types of imports. But details on this are still to be determined. And again, the timeline is much longer. But if there are significant changes to de minimis in the United States and in the European Union, which are the two largest markets for these types of e-commerce goods going by air, this would certainly have a much more significant and more profound impact on air cargo demand and rates. But as we just mentioned, the de minimis or challenges to de minimis and the chance that there were going to be changes or restrictions or the complete cancellation of de minimis in the U.S. and as we saw also in Europe. This did not come as a surprise. So the kind of the abruptness and the timing was a surprise in terms of what we saw last week, but really kind of the writing has been on the wall. There have been multiple bills proposed in the U.S. last year, and the Biden administration had also put in motion a U.S. Customs and Border Protection rule change that was announced just a few days before the end of Biden's term. And this would close de minimis to about 60% of Chinese goods that are coming in via this exemption. And that process is still in effect. So on January 17th, they announced a 60-day review period or comment period. And after that, at some point, the rule change should go into effect. So kind of this was certainly on the radar. And as we said, there's been a shift to ocean freight by some of these platforms and domestic warehousing and logistics and fulfillment. And a lot of Shine and Temu vendors have also been relocating to places like Vietnam or Thailand and Malaysia, which would allow goods from these countries still to enter via de minimis. So I think we can expect that the coming changes are going to have, as I said, a significant impact on the air cargo market. But I shouldn't think this will be the end of cross-border or Chinese e-commerce presence in the U.S. or Europe once that change happens, nor expect that this is going to mean the complete disappearance of air cargo of e-commerce, cross-border e-commerce in air cargo. But again, I think this is going to be significant. Okay, so in terms of looking at what this looked like in terms of air volumes and rates, here we're looking at the latest IATA data for air cargo volumes, which is from December. And we see it shows 17 months of consecutive year-on-year growth, and many months it was month-on-month growth. We see that volumes have even surpassed levels we saw during the pandemic. The year totals for 2024 were 11% higher than last year and broke the record set for annual volumes back in 2021 during the pandemic. Again, the biggest driver of volume strength has been this nonstop surge of B2C e-commerce volumes, mostly out of China. Again, especially to the US and Europe, where volumes increased respectively 8% and 10% year on year in December, and have had year on year growth really every month this year. And if we look at capacity has increased too throughout the year. It's reached record highs. There was this period of recovery from pre-pandemic levels, but we've seen that recovery and then surpassed in the last year or so. And we've seen rates climbing anyway. So even though we have record capacity, we're still seeing a lot of pressure on rates, which just shows the strength of that demand growth. But if we're about to see kind of a significant decrease in demand and volumes, this capacity growth could threaten a state of overcapacity if we do see a significant enough exit. Likewise, an e-commerce shift away from air cargo could put an end to this nonstop volume growth that we've been seeing. Okay, so finally in air cargo rates, here we're back in terminal looking at our Freightos Air Index. In blue, we're looking at China to the US, and in green, China to Europe. And here we're at back in about mid 2023, rates had come down from the pandemic highs we had in 2022 and in the first half of the year. But we saw starting in peak season, rates increased up to about the $5-6 level for the US and $4 level for Europe. And even though there was some seasonality since then, we saw rates really stay at these elevated levels ever since. We had some increase, especially to North America during peak season. But even now that we're past peak season, rates are down at more than $5 per kilo. This is more than double typical levels, which were about around the $2 range for these lanes. So we've seen upward pressure on rates this entire time. As we said, this is really something that is being driven by these e-commerce volumes. If we take the starting point before the e-commerce surge, so really the big increase in e-commerce volumes started somewhere in the middle of 2023. So if we were kind of remove that factor, could we expect rates to go back down to the $350 level, to the $3 level for Europe? I think it's possible. But also this period back here was also a period of a kind of a shortage of capacity, that we're still in that recovery period during the post-pandemic stage. So if we know that capacity has recovered since then, if we have a big enough exit of volumes because of e-commerce and because of this change to rules, that could have an even stronger downward impact on rates. And this is something that is going to have to remain to be seen. We can see that rates did go back to normal on some lanes. So here we're looking at transatlantic. And by the middle of last year, we had rates down to about $1.50, $1.60, which is about normal range. And then we had rates increase into peak season, which is much stronger than usual that you would see on this lane. And this is because capacity was shifted to the Trans-Pacific or to ex-China because of this demand during peak season, especially for e-commerce goods. So this is just to say, if you move capacity from one lane to another, it impacts rates. And if capacity all of a sudden opens up, it could impact rates. It can impact rates on lanes not directly involved in this kind of e-commerce trade and volumes. And then finally, we see a similar story out of other regions as well. This is South Asia to North America and to Europe. We see the same thing, rates increasing significantly at the beginning of last year and just staying at that level. And we see something similar from the Middle East, which reflects the sea air demand, right? So we have kind of lower rates towards the middle of 2023, an increase in rates and just staying at these elevated, much above normal levels. Again, and we're probably sick of hearing it, a lot of this is because of this e-commerce factor. Certainly the Red Sea is one component, which has pushed some volumes from ocean to air, but the big factor has been e-commerce. So I think it's important not to overstate, but also it's hard to understate, not to understate that if these rule changes do have a significant impact on what's going by air, we're going to feel it in the air cargo market. Okay, with that, Adam, let's turn to you. Let's start with tariffs on Canada and Mexico. So these were on or almost went on, and then they're off again. But there's a March 4th deadline looming. Let's start with, how likely do you think is the renewal, and then what happens if they're reinstated? And let's start with, more specifically, what would the impacts be on intra-North America customs processes and on logistics in these on the U.S. northern and southern borders?
Look, I'd say, the likelihood is probably your guess is as good as mine. We're not dealing with a traditional administration or an administration that's using traditional means. So it's really tough to say. It's really going to be about what the Mexican and Canadian government are willing to concede. I think it's becoming more apparent that these tariffs aren't necessarily about fentanyl crossing the border, as we've seen with Trump putting these steel tariffs in place. I think he's more or less setting the stage and creating the leverage he needs to renegotiate the terms of NAFTA. That's what it's looking like. So, I mean, if you were to ask me last year, what were the possibilities of there being a 25% tariff placed on Canadian and Mexican goods, I'd say that's next to 0%. But with what we've seen go on thus far, I'm actually thinking it's more and more likely that they will go ahead with these tariffs for a short period of time to just increase their leverage for renegotiation. Yeah, go
ahead. And what would that look like in terms of customs process? Let's say these do go into effect. What does that change at the borders? Let's talk about the actual process of getting goods across the border and not talk about how this impacts demand first.
Right.
What would that look like?
I mean, look, it'll have a significant effect on, not only Mexicans and Canadians, but Americans as well. Between the three countries, they've spent decades on, integrating their supply chain. So I would say that, as an importer into the United States or into Canada, wherever it might be, you have to be prepared. there's certainly going to be some scrutinization in terms of country of origin claims, right? So these tariffs they're putting in place are based on the country of origin. So for the United States, if they're putting a tariff on Canadian goods, it's really only about goods coming in or that were manufactured in Canada. Now, with that, US CBP is going to be scrutinizing your country of origin claims to make sure that you're not passing off Canadian-made goods as something else. And then with that, you're going to have scrutinization on your classification codes as well as your valuation. So definitely you're going to want to increase your preparedness. You'll more than likely have increased costs in terms of the potential for needing a higher bond, increased bond requirements. Inspection rates are certainly going to go up, and more than likely you're going to have freight rates going up as well. Overall processing times, it's not going to be cheap. So you need to be prepared, and definitely you're going to have some unexpected costs that you were not expecting in the previous years.
There's been a lot of talk specifically about automotive, and I think probably more so. I know automotive is important in terms of share of imports coming from Mexico, but I know that kind of Michigan and Ontario are very enmeshed in terms of automotive components and different kind of stages of manufacturing and assembly that items or different parts can kind of cross the border multiple times. What are kind of the challenges there, and what would that look like if tariffs are actually imposed?
Well, number one, cars are certainly going to get a lot more expensive. Like you mentioned, cars can cross the border multiple times to complete their manufacturing, to add components, come back and forth. That's part of NAFTA, right? So either we're going to see a shift in complete manufacturing into the United States, or the United States might look to other countries. For example, last week, President Trump met with the Prime Minister of Japan, who announced significant investments. They have a large automotive sector. You can start to see, portions of a vehicle be made in Japan rather than in Canada and Mexico, and brought in for completion. This is certainly going to raise the cost of a vehicle short term, and long term. I would expect that the United States is going to try and manufacture as much of a vehicle as possible, and shift away from Canadian and Mexican manufacturing.
Okay. If we look at the tariffs from the first Trump administration, we certainly did see a decrease in China's share of U.S. imports. So we look at total U.S. imports, China's share fell, and actually they were replaced by Mexico as the largest trading partner for the U.S. in terms of imports. We also saw a shift, as we mentioned just now, even in terms of e-commerce, to other sourcing partners in Asia. The assumption is that you can find replacement sourcing in different places. Is that the case for the kind of mix of goods that is traded in North America? Or is this just going to mean that tariffs are going to be paid, and if the manufacturing that can be shifted to the U.S. will be shifted, and otherwise there's not a lot of options? I know there's a lot of talk of it will cause an avocado crisis,
Okay.
but are there other examples, or are there could we expect this if this does go into effect to have an impact on to increase imports from other countries?
Well, there are viable replacements, but they won't come quickly. Just like anything, in this life, most things can be replaced, but at what cost? Obviously, with the geographic proximity that Canada, the United States, and Mexico have, it will be tough to, just replace, at least at the same cost. But like I had mentioned, Trump has already been looks like he's already been speaking with other countries to at least find viable alternatives, working with other South American countries to replace some of the agricultural needs of the United States. Canada and Mexico will most likely turn to China, the EU, or other South American countries, to export their energy, raw materials, agriculture. But there's a reason why our the North American trade is so integrated because of that geographic proximity. But look, anything is replaceable, but at what cost?
Yeah, got it. Okay. If we shift now to the other aspect of the Canada, Mexico, U.S. Tariffs or barriers, the other big one was de minimis. So this is also part of that now paused executive order. What would canceling this intra North America de minimis mean for shippers and consumers? Do you think these parcels are going to keep coming? They're just going to become more expensive, or is there going to be some other kind of shift?
Look, costs are certainly going to increase. Transit times are going to decrease. Since 2016, when the Obama administration, upped the de minimis from $200 to $800, U.S. consumers and Canadian and Mexican exporters became used to having relatively cheap duty-free items just show up at their door. That's certainly going to, I wouldn't say it's necessarily going to go away, but it's going to become more expensive. In the short term, shippers will more than likely absorb some of those costs, pass some of them on to American consumers. I don't necessarily think it's gonna dry up, at least not right away. I don't think Canadian exporters, Mexican exporters are necessarily going to want to shake up their supply chain right away. This is very much kind of like a moving target. If Trump does cancel the de minimis, for how long? Do you want to make such drastic changes to your supply chain right away? I think in the short term, it's not necessarily going to dry up. Some of those costs will be absorbed by both the shipper and U.S. consignee. But compliance may become an issue. Whereas without de minimis, there are a lot more requirements when it comes to a formal entry. So I don't necessarily think it's going to dry up and just go away, but it will be more difficult, more expensive, and more time consuming.
So we said like almost 2/3 of de minimis de minimis imports into the U.S. were from China. I'd imagine a big chunk is from the North American neighbors. What's the mix of goods like? In other words, we know from China's a lot of apparel or electronics. Is there a different type of de minimis, typical de minimis types of goods that go by de minimis from Canada or from Mexico?
I would say there's a lot more textile goods coming in from Canada and Mexico more so than from China. I mean, look, we know that China is able to produce electronics and eyewear far more cheaply. But look, there are also Canadian and Mexican businesses that have been created over the past decade or so to supply American consumers with these very quick, cheap items. So you'll have businesses across Canada who are actually importing goods from China, holding those kind of duty free within the country, and then re-exporting them to the United States, or exporting them to the United States without any duties paid, and next to no compliance. So very cheaply and quickly. The mix of goods, it's kind of relatively the same. But I would say there's more so textile goods coming from Canada and Mexico than anything else.
And if de minimis remains open for Canada, let's say, but is closed to China, we said the country of origin counts, right? So would it mean that those types of goods from Canadian sellers would no longer be eligible?
As long as they're made in China, they would no longer be eligible now.
Okay. So it's not like you could expect kind of just a big surge uptick in de minimis imports from Mexico and Canada if this is reinstated as if de minimis is suspended for China. Although I know there's a lot of big increase in volumes into Mexico from China, but that involves some some, I don't know, repackaging, but assembly of components, and then it's not considered from China. So I don't know if that's kind of something on the radar that's expected if we see this reinstated the suspension on China, but not on Mexico and Canada.
Yeah, well, like I said, the suspension is really on the country of manufacturer. Of course, you do have goods that are shipped into Mexico or Canada to be finished, which might change, the country of origin requirements, which would make them, even though, let's say, 40 or 60 or however percent of the product was manufactured in China, depending on how it's assembled in Canada or Mexico, it could then qualify as country of origin as Canada or Mexico, and therefore qualify for de minimis.
Okay, got it. So it's possible we'll see kind of some of the share of de minimis that might go away directly from China. See some of that compensated from the other North America neighbors. Continuing the de minimis discussion, and now let's focus on China. We know it was canceled and then reinstated temporarily. Do we know, first of all, what drove this decision, and what will this mean for U.S. Customs, either right now or what it mean in the short term? I've seen some stories, all of a sudden, individuals in the U.S. having to pay $25 for their kind of a low volume import or value import. What will this mean once de minimis actually is suspended?
So the reason why it was suspended more than likely was because of the strain that it did put on CBP, U.S. Customs Border Protection. They were not necessarily prepared for an influx in informal entries. This added millions of shipments per day that have to be reviewed, and they simply don't have or did not have the systems or processes in place to be able to do that properly. That's the reason that we assume. There was no official reason given. But I mean, look, it was essentially given a 30-day reprieve, this pause in de minimis. But I do suspect it will take longer than 30 days. If it were to be put back into effect, I think it'll be longer than 30 days. Like I mentioned, US CBP is going to have to make significant upgrades to their systems and processes to be able to handle that much of an influx of parcels coming into the US, or formal parcels coming into the US.
And I think this probably doesn't mean the end of Temu and Shein in the U.S. market. I talked a little bit before about they're increasing their shipments by ocean, they're increasing warehousing and domestic logistics. What are other ways that they're looking to kind of adjust, preparing for this change?
Well, look, I'm sure they're starting to look at bulk entries or using what's called a consolidated invoice, which essentially means that you have one exporter in China who is Temu or Shein, whoever it might be, and thousands of consignees within the US, but they consolidate it onto a single invoice, which they can bulk clear into the US. So rather than paying
and here we're talking about even still going by air.
Yeah, you can do this by air, by ocean, whatever it might be. Keep in mind, this is more costly than what they've been doing before. Therefore, shipping by air is probably not as attractive as it once was. And doing this, using this method, the exporter, in this case, Temu or Shein, would be acting as the importer as well. So they would actually have to account for the duties and taxes and fees for these goods coming into the US. It is a complete change in their business model, but this is a way to minimize the costs in terms of brokerage fees. But this does not, mitigate any kind of duties and taxes. And of course, there are administrative costs that go along with this in terms of, yeah.
Yeah. So this would mean that these platforms could still use air cargo. It's not the individual parcel that's now going to have $15 to $50 per for the $5 T-shirt that the U.S. person in the U.S. is going to have to pay for. But it does mean slowing down, right? It means that these shipments have to go through formal entry, which could last a week in a customs warehouse. And as you said, there are these additional costs, even though it's going to be distributed against this entire shipment. What do you think that the difference would be in speed and cost for the actual consumer? Like how what types of costs would need to be passed on to the consumer for this to continue to make sense for these platforms?
Well, look, I would expect cost to go up, at least 40 or 50%. You're looking at, goods from China that, would have an original duty. So, most goods coming from China do have some duty, anywhere from, 7 to 18, 19%. Of course, you still have Trump's original tariffs, his USTR 301 duties of about, 7.5 to 25%. Now you have this additional 10% duty that was placed on all Chinese goods. You're then going to have somewhat of a cost in terms of brokerage fees, so actual filing fees. It would be pretty minimal using a consolidated entry, but it's still there. And then again, you have these administrative costs. So I would expect costs to go up significantly to U.S. consumers. And I mean, look, there's still the possibility of using air freight, but in this case, with the expected scrutiny that these large e-commerce retailers are going to come under with these new tariffs put in place, using air might not be such a great idea, especially given the fact that when a shipment lands by air, you generally have up to 48 hours to get that merchandise out before it starts running into storage fees. With the expected scrutiny that they're going to see, that's a big risk to take. You are much safer actually moving this in by ocean, where you can have up to 5 days. So if some of the cargo is going to be held for inspection, if there's going to be any kind of paperwork scrutinization, it's much safer to bring it in by ocean. Of course, you're saving a lot of money in terms of the actual transit fees. But once they arrive in the United States, you have a high risk of inspection. Therefore, moving it by air does not seem nearly as attractive as it once did.
So moving e-commerce goods by air, some of it is probably still going to take that option, even though it's going to be more expensive, as you said. And when we did the calculations earlier, this could mean up to like a 50% increase in cost to the consumer. So in the actual price tag. So if we could reasonably expect, not e-commerce not to disappear from the air cargo market, but this still to have quite an impact. If you had to guess, what do you think kind of the reduction in volumes are going to be? What kind of share of de minimis volumes from China to the U.S. do you think are we going to see reductions in whatever the time the time frame?
I mean, look, I think it'll be quite significant. The majority of de minimis parcels coming to the U.S. are actually quite low value. I think most of them are somewhere around $20 or $40. Of course, de minimis goes up to $800 for some more expensive, time-sensitive products. Using air cargo might still be feasible, but the vast majority of this cargo is very low value, and without de minimis and these Type 86 entries that basically have the speed, it basically lands and it's out for distribution right away. Without that, the possibility of having increased costs once the goods actually land are too high. That I would say that the vast majority is going to shift to ocean cargo.
Okay, so we'll see how this plays out. I think I agree. I think it probably means that e-commerce isn't going to go down to zero. It's still going to be a factor, but not kind of seeing at the levels we've seen, and certainly not the growth we've seen. I think we'll probably see some contraction. Okay, Adam, thank you very much. I've left us only 5 minutes to the end of the hour. If you can stick around and answer some questions, I'm happy to as well. But we won't be offended if people start dropping off. Because as we're might go over a little bit. So we have some questions here. There's one for you here, Adam. There were Biden proposals to charge $50 per shipment for de minimis. That doesn't seem to be the case anymore. Have you heard anything about that? And if de minimis is canceled, well, I guess that's what we talked about already. So let's start with that one. Have you heard anything about the Biden proposal to charge $50 per de minimis shipment, which would really, I guess that's a different method to say if you're going in by de minimis, then you're being charged this. That would kind of require a different strategy than what you were just talking about before. Have you heard anything like that?
No, I haven't heard anything like that. I mean, look, there's a lot that kind of floats around, but until it comes through an official channel, I think it's really just hearsay. I mean, look, charging $50 for, for a de minimis entry doesn't make a ton of sense. Again, the majority of goods coming in by de minimis are actually very low value goods. But look, there are changes that US CBP can make that won't necessarily require a formal declaration. They can still use a more informal declaration, but just increase the requirements. Right now you can, or up until recently, you can go on a Chinese website and buy something like a an e-bike online for $799 and essentially get that in completely, skirting any kind of partner government agency requirements using these Type 86 entries. I don't think necessarily just charging $50 is the answer here. I think this is, the U.S. government is looking at this at more of a compliance level, and how they can increase scrutiny on these packages while maintaining the speed. It's not necessarily about trying to collect more revenue.
Got it. Okay, next question is, how are we viewing this round of trade policies impact on the growth if we compare to 2018? Are we seeing optimism in terms of the overall set of policies, even as front loading may taper off later on? And then also, what about pass-through costs compared to 2018? So, I think the difference this time. So, first of all, I think it didn't the tariffs from the first Trump administration that remained in place during the Biden administration. It didn't impact kind of trade and overall volumes, but it did cause a shift in trading partners for businesses in the United States. So as we said, we saw Mexico, replace China as the biggest trading partner. We saw increases in sourcing for U.S. sourcing from places like India and Vietnam. So that was certainly an impact. The overall reliance on, or the trade deficit, I think, did not decrease as a result. And we saw, still a heavy reliance on imports and not much of an impact on manufacturing. The question of the contributions to inflation got kind of swallowed up by the inflation during the pandemic, so that's a little bit harder to attribute. But I think the expectations are that these types of tariffs will result in higher costs. And as we said, it's not so easy to find alternative trading partners so quickly, especially if there are significant tariffs on all three of the U.S.'s largest trading partners, the U.S., China, and Mexico, make up over 40% of imports by value into the U.S. last year. So, as opposed to last time where the focus really was on China, if we see 25% also on Canada and Mexico, if we see these, maybe not 10 to 20% across the board, if that were the case, then there are no alternatives except for domestic, which there aren't always replacements for every type of good. So I think the expectations are that if these tariffs are broad enough, then it could have the effect of depressing trade overall, which is something we didn't see the first time. But again, it really remains to be seen the extent to which these tariffs actually go into effect. There's a question about information about tariff increases on European Union goods. So this has certainly been something mentioned by the president, but not given a specific timeline. Adam, have you heard anything more specific about the plan for the EU?
No, I mean, there hasn't been anything that's come through any official channels. Again, Trump likes to use these kind of threats in terms of tariffs to be in a better position for negotiation. I haven't heard anything, but given the fact that that he was about to place tariffs on Canada and Mexico, does not seem unlikely that he would do the same on EU, who doesn't have the same partnership or allyship as the United States does with Canada and Mexico.
Got it. Here is another question, or this is an e-commerce question. If e-commerce does have a significant shift to ocean, would it be significant enough to absorb overcapacity? And I think the answer there is probably not. So at the moment, we don't really have overcapacity, right? We're seeing some blank sailings for Asia, Europe. At the moment, the real capacity factor are these Red Sea diversions, which are absorbing capacity because vessels are taking longer on those routes, and also because carriers are adding vessels to those routes to keep up with schedules. So that's the real factor of capacity. I think if you saw e-commerce shift to ocean, I don't think it would have a profound impact on ocean volumes into the U.S. And Adam, I don't know how if you would agree. That's kind of my even if you're having 80 freighters per day, that's not so many containers all in
Right.
all. So I think that probably isn't the issue in terms of capacity. The real issue is the Red Sea. If we see Red Sea traffic resume, then that's going to be the big threat to overcapacity from the carrier perspective. Um, Here's a question for you. If we import textiles from China and then distribute them in Canada or Mexico, since those are products that are made in China, sorry, this is from a perspective of a U.S. company, would they be subject into Canadian and Mexican retaliatory tariffs, or just the U.S. tariffs on China? So in other words, this is a U.S. importer bringing in goods from China, would pay tariffs for importing Chinese goods. Now they're exporting them to Canada and Mexico. What would be the perspective of Canada and Mexico in terms of how those are being viewed to enter those countries from the U.S.?
So yeah, so the retaliatory tariffs, or these tariffs that are putting on place, are actually based on the country of origin. It's not from the country of basically where they're shipped from. So Canada at the moment does not have any retaliatory tariffs on Chinese made goods. So if you were to import products from China and distribute them to Canada, you wouldn't necessarily have additional duty other than, if you're looking at textile goods, it's usually around 18% into Canada, anywhere from 16 to 18%. But there would be no additional duty on top of that. So it would basically be business as usual, and hopefully you'd have the ability to file a drawback and at least recoup some of the duties that you paid on your import into the U.S.
Okay. Interesting. Here's one more for you, and then I think we'll do one more after that, and then we'll let people go. Here's the context. We're talking about a U.S. entity that owns inventory at a foreign bonded warehouse. The question is there any limitation from a compliance or fiscal perspective that limits the U.S. entity's ability to re-import goods to the U.S. as a return of U.S. imported goods, duty-free to fulfill U.S. orders?
Okay, so you're talking about a U.S. entity that is holding stock in Canada in a free trade zone. Is that what I'm
Foreign
understanding?
bonded, yes. Foreign
Okay,
bonded.
so a foreign
This is
bonded
your
warehouse.
this is your.
I'm
Okay,
just
wait.
trying
I'll
to.
give you more info. The COO CN freight previously formally imported into the U.S. No drawback claimed. I assume you know what that
Okay.
means.
Yeah, so the country of origin was from China, was imported into the US, moved into a foreign bonded warehouse, meaning that they did not pay the duties into that foreign country, and they're looking to bring it back into the US without paying duties and taxes. So there is a possibility to do that. We do, as a broker, we do have an annex code that would say this is US goods returning, but you must prove that these goods were exported. So as long as you have that paper trail showing that you did export these goods to a foreign country, whether it's Canada, Mexico, wherever it might be, or overseas, and you're now bringing it back, as long as you can maintain the original import documentation into that country, if you have export documentation from the United States, yes, that can come back into the US duty free.
Okay, interesting. Adam, thank you very much, everybody. Thank you for joining. You can, see a lot of the rate data and other customizable data that we talked about today in Freightos Terminal at terminal.freightos.com. Adam, where can people reach out to you if they want to learn more?
You can visit us at clearitusa.com or clearit.ca.
Okay.
Feel free to reach out to any of our very helpful staff through any of our contact means.
Okay. Awesome. Well, Adam, thank you very much again for your time. As always, this was illuminating, and thank you to all of you for attending. And we hope to see you next time. Bye-bye.
Thanks for having me. Bye-bye.